Hi there, welcome to the Stockscores market analysis for September 8th, 2010. We're going to go through most of the symbols that you see here on this table, looking at the charts of course. Let's get into that right away. To take a look at the charts in gallery view, I just click on the gallery link at the top and we can see all of the charts that I have in that table in a sort of miniature view. What I want to start off with is gold and oil. We'll take a look at oil first. This is a chart of the oil ETF that trades on the American Stock Exchange, symbol OIL. And it is generally in a bearish pattern. We have falling tops over the longer term. However, it is near support, which should hold up. And so my expectation for the short term is we probably will move higher, although not that much higher because of this downward cycle for falling tops. Moving along to the gold chart, I'm going to use the ETF GLD for gold. Here it is right here. And gold has had a great run over the last 6 weeks. It is now at resistance where it should get stuck. We still don't see any sign that it is getting stuck. What I would watch for is a break of that upward trend line. And so while gold and gold stocks look favorable now, I do think that there is a fairly significant chance that we get a break to the downside in the short term as gold encounters some resistance. The next chart I want to take a look at is a chart of the 20-year bond, Treasury Bond Index, ETF. And the reason I pull this up is because the U.S. Treasury bond market has been something of a safe haven, and people have been going there as a way to escape risk. And as a result, this normally pretty boring fund has done very well to the upside. What I think we should notice here is that this thing really ran away from its trend line. It's now pulling back to the trend line. That tells us a couple of things. Number one, people aren't as scared as they were in August, and that probably gives some strength to equities. But also the trend is still up, and so that fear trade is not gone yet. It is just cooling off a little bit. If the Treasury bond can break that upward trend line, then really what the market is saying is it's willing to put money back in equities. That's not the case yet. We are in the first stage of that process where the market begins a pullback to that upward trend line. Now, part of this trade is the strength or weakness in the US dollar, since the US dollar is, I guess, the safe haven globally. So as the market is worried about things going wrong in the world, it tends to buy US dollars, and when things get better, it tends to sell US dollars. And we can see that we had a pretty good pullback in the US dollar, followed by a break of the downward trend line sometime in August. That was as that fear trade came back on. We're now building a rising bottom consolidation here, and I would say that the market is slowly starting to move away from the US dollar, and that is helping stocks. That helps commodities as well. I think that this market is more likely to go down than up in the near term, but given that this upward trend line was broken, I wouldn't rule out the risk trade coming back. And of course, if that were the case, we would also see a bounce off of the upward trend line for the TLT, the bond index, and that would be again a sign that people are still worried about what's happening in the world. All right, let's move along to the Canadian dollar since we're looking at currencies. I'm just going to cycle up here to the Canadian dollar ETF. The symbol for that is FXC. And here we can see that the Canadian dollar has pretty much been locked in a trading range for some time. It has not had the volatility of many other global currencies, and I suppose that is a good thing given how the world has behaved in recent times. However, it also means that there's not a lot of excitement here. I think the Canadian dollar probably will continue to wind its way within this trading range, somewhere around 95 to 97 cents on the US dollar. In the short term, it does look a little bit favorable. We may move up towards the upside of that range, up towards 97 cents, but I don't expect long-term strength in the Canadian dollar in the near term. Canadian market is quite similar to the Canadian dollar. It is essentially been locked in a trading range for some time. We are near the top of that range, and you can see this chart here. It's kind of a boring chart, which for many investors would be a good thing given how the global markets have behaved over the last year. Canadian markets have just kind of grinded their way sideways, a safe place to be, but not necessarily an exciting place to be. However, select stocks in the Canadian market have been able to do well because they haven't had that general fear concern that has been in many of the other markets. All right, let's finally take a look at the S&P 500 as a sort of benchmark for the U.S. indexes. Here's a chart of the S&P 500 here. And a lot of volatility in there, a lot of uncertainty. There's no clear trend. It makes it a very difficult market to trade. You know, when you have a market trending like it does here or like it does there, those are easy situations to trade. What we have right now is really no trend. We've been trading sideways with short bursts up and down. The current burst is to the upside. We are nearing resistance where the market should get stuck, and we are some distance away from support. So there's a fair amount of downside risk and relatively minimal upside before we hit resistance. So I would suggest some caution here. I think if you own stocks in the US, they probably are still worth holding because the market hasn't turned yet, but I would have a little bit of awareness given that we are nearing that upward trend line. So in general, I think that the markets are uncertain. Given that we are going into September, that's pretty normal, but realize also that the seasonality for stocks, that time when stocks do their best, is approaching quickly. We tend to see the markets do quite well from October till May. The best month of the year for stocks tends to be December, and September tends to be the worst. Now, I think we may have the worst behind us because August was such a rough month, and so I'm not sure that we will get the same September effect as we have had many years, but at the same time, the market really lacks volume, lacks conviction, and so you need to only trade the very best setups that come along. Well, that has been the Stockscores market analysis for September 8th, 2010. For more information on the tools and services offered at Stockscores, please give us a visit at www.tradescores.com. Have a great week in the market and trade well.